The bubble is exploding. The housing crash has begun. The USA is facing a possible risk of a greater downfall in the real housing market. The sector is facing a fatal period in 2023 with opposing conclusions on the future of the market. This has led to several economists awaiting a balanced market, while others are concerned about a collapsed market in the future. Inflation is rising. There's panic about a looming recession in the country as a series of signs suggests more trouble is ahead. So are we now witnessing similar circumstances to the 2008 disaster, or will this time be even worse? Housing has caused one of the worst financial crises in modern times. So the question is, are we in a housing bubble? The quick rise of the housing market has lasted for a long time, estimated as the length of the COVID-19 pandemic. The rapid market value development describes the housing market up until approximately mid-2022. Based on Redfin data, this includes home price growth which was in the double digits year over year every month from August 2020 to mid-July 2022. Yet, indications of a housing bubble may be waning now. For months and months, the prices have declined since the summer of 2022. And according to Redfin, home prices are still up year over year. In December 2022, the increase was 1.3% higher than in December 2021. Mike Reynolds, who is the Vice President of Investment Strategy at Glenmead, said that the home prices are overextended. He added by saying that they should be given a mortgage rate. While mortgage rates are independent of the federal funds target rate set by the Federal Reserve, they often rise and fall as a result of the Fed's action. The federal funds target rate was laid down continuously in 2022 to fight inflation. From sources, the average 30-year fixed rate in mortgage interest extended over 7% in October and November 2022. But according to Freddie Mac, the average rate dropped to 6.12% on February 9th. Some homebuyers are staying on the sideline, even after the mortgage rate has fallen. This is because of the high home prices. This factor keeps the inexpensiveness low. The low supply of houses on the market has been a major source of fast-rising home prices even before the 2019 pandemic. This has led home builders to back off plans for major expansion and home sellers to pump the brakes as well. This means they are choosing to live in their current homes rather than take part in high mortgage interest rates. A lack of interest will ultimately lead to declining year-over-year home prices. However, that doesn't conclude that the bubble will burst. Reynolds predicts there will be a time when homes will be priced to where buyers will afford them. His words being, it's possible a little bit of air let out of this bubble, but an outright burst is unlikely this time around. Does he have a point? Housing markets do not instantly crash. Several changes will exert pressure on the market over time. This, in the end, leads to its collapse. When home values peak too fast, a housing bubble rises. When there's demand and the capacity to buy, it may increase. When there aren't sufficient houses for sale, this leads to demand and the price ends up high. When a housing bubble widens and pressure expands, the market may crash. The economy is further lowered by interest rate hikes. Demand and jobs might fall, and we can say that oversupply boosts a buyer's market and cheaper pricing. The real estate market might then stall down. So how can one know how awful and how fast is going to be better? This depends on how workable development was before the events of the slowdown. Many worries remain about the housing markets. The biggest driver of the growth of the price of homes has been inadequate supply. The higher rates are curbing both potential sellers and new construction. With this, there's no relief in sight for the development of housing-related supplies. Some sources say the price can decline without a crash. So what do they mean? The decline in the total figures for home sales is stark. In December 2022, there were 36% fewer homes sold than in December 2021, according to Redfin. However, the ability now is to wait out economic uncertainty and other factors such as climbing interest rates. Maybe this is what keeps any drop in home prices from becoming more concerning. Jared Kessler, the founder and CEO of EasyKnock, says that markets that experienced growth in home prices have risen in recent years. He further added that we're more likely to see bigger dips as prices correct to fit with long-term demand. Kessler's other words were that prices moved up so much. High prices have resulted in a lot of places losing buyers. Now, investors are looking to make income from buying single-family houses. The process of buying single homes and flipping them is referred to as iBuyers. Home ownership can sometimes feel scary during a point of economic uncertainty, mainly if there's a horrific recession and market crash that took place in 2008 and 2009. Predatory lending practices in the first years of the 21st century meant several homeowners facing foreclosure when modified interest rates rose. Unemployment further raised the number of properties in foreclosure. House demand was propped up by issuing mortgages to people who weren't in a good financial place to buy. The economic downturn also meant buyers' demands plummeted. Home values declined significantly as a result. Rick Sharga said that the current situation is different compared to the Great Recession. He further said that mortgage delinquency rates are lower than they were before COVID. He said that 2019 was in itself a mild year for foreclosure activity, historically speaking. Economists also agree that the prices could drop. However, they also added the decline won't be as severe as the one homeowners experienced during the recession. One obvious difference between now and then is the homeowners' personal balance sheets are much stronger than they were 15 years ago. The typical homeowner with a mortgage has stellar credit, a ton of equity, and a fixed-rate mortgage locked in at a rate below 5%. So this means there are no foreclosure crises looming. Molly Bussell, an economist, said that the wild ride known as the U.S. housing market slowed in the fall of 2022. She also talked about mortgage rates remaining high. She further added, home sales started in early 2022 but took a nosedive later in the year. Molly talked about how the generous amount of home equity will protect many borrowers. This will prevent them from experiencing foreclosure activity seen during the Great Recession. Builders also remember the Great Recession very well. They've been careful about their quickness of construction. This results in an ongoing scarcity of houses for sale. Furthermore, Yun said that some price markets will decline further, adding that a repeat of a 30% price drop is highly unlikely. Reynolds pointed out another difference linking today's modern market and housing mayhem. He said the issue of supplying excessive building led up to 2008. This meant that when the demand dropped, there were entire housing developments that sat vacant. Into 2023, housing is still catching up on the low rate of building contrasted to households. This has been since the formation, since the 2008 disaster in the recession sector. To further add up, Reynolds said there are fewer homes per household than there were back then. In today's time, laws and regulations have been in place to curb predatory lending since the Great Recession. Even as high house prices and rising interest rates have increased the total cost of buying a home. This has made homeownership unaffordable for otherwise would-be homebuyers. There are still more qualified buyers searching for homes than there are properties for sale. From these factors, Reynolds has built a solid statement as he and his colleagues agree that the crush is unlikely to happen. However, is that the case? If you're enjoying the video, please click the like and subscribe button now. On many occasions, economists have been judging the housing market. They say the housing market could finally cool as home values become a victim of their own success. Home prices have increased far more rapidly than incomes, creating an affordability squeeze. We have also seen mortgage rates double since August of 2021 before commencing to retreat a bit. There was a chart that represents the median price from March 2020 to January 2023. The chart shows that the median price of homes sold by realtors has retreated in recent months. Economists say home prices could fall. Dietz's prediction stated that most markets are going to experience price falls in the high single digits. Home price declines of 8 to 9% would create economic distress. However, this correction would be nothing like the collapse of property prices during the recession period. Yoon says high-price regions such as California are the most vulnerable to downturned prices. However, the Midwest is unlikely to see a fall in home prices overall. Yoon expects national prices to remain flat next year. The present state of real estate is currently regulating at peak inflation. Furthermore, higher interest rates are giving real estate companies and experts a run for their money. The pressure of these forces is causing struggles for those who make future predictions. The CoreLogic Market Risk Indicator, known as MRI, indicates a monthly update of the overall state of the housing market across the USA. For example, the MRI predicts that Bellingham, Washington is at huge risk of a fall in home prices for the next year. The MRI is a model that lays out a probability score from 1 to 100. CoreLogic is a leading global property information analytics and data-enabled solution provider. Moody's Analytics, a leading services firm, has relatively bearish outlook for the market. Moody's forecasts a 5.1% drop in national home prices between the fourth quarter of 2022 and the fourth quarter of 2023. The results are expected to vary significantly depending on the regional housing markets. It also depends on individual neighborhoods. Mark Zandi, a chief economist, explains that prices in these markets are less sticky than they have been in the past. This is due to the rapid price increase during the pandemic. Sellers in these markets are willing to lower their prices rapidly in an effort to close a deal. In the other case, Zillow remains optimistic about the U.S. housing market in 2023. This is because of a forecast of a 1.1% fall in home values between November 2022 and November 2023. Zillow anticipates 658 out of the 897 markets to experience a decline in house prices between November 2022 and November 2023. Markets such as San Francisco, San Jose, and Santa Rosa are among those that will notice a fall. On the other hand, 239 markets are expected to see positive or price development between November 2022 and 2023. The U.S. housing market for 2023 remains unsure, with a forecast for Moody's Analytics and expected variation in regional and neighborhood markets. The markets that got too detached from the fundamental values during the pandemic are at greater risk of price correction. However, others that are not significantly overvalued are expected to fare better. Anyways, despite the differences in predictions between Zillow and Moody's Analytics, both highlight the fact that results in the U.S. housing market could vary significantly across different regions and neighborhoods. The housing shortage is too severe, and the majority of Americans are hoping to avoid another 18 months of hardship. Housing demands from millennials and Gen Z are also expected to remain strong. While there may be a decline in demand, there are no strong signs of a housing market crash in 2023.